Ladies and gentlemen, today things went from bad to worse as far as how I'm viewing this market and what I'm expecting going ahead. I'll just tell you right now, I think this is the first inning as far as what the downside could look like for markets over the next coming months and maybe even over the next year or so. Who knows how fast things will evolve. But you are at the very start of this, and I will explain that here in this video. There are growing calls for the Fed to potentially even, or maybe even rumors, I should say, that the Fed may actually come out and do some kind of emergency cut, potentially before or right after Jackson Hole. Now, that's a possibility. And we will discuss what I think the odds of that are here in this video. We will discuss as well what I think is coming next for Tesla and markets in the short term, because I do think we could be set up for a little bit of a bounce, but we have to acknowledge something right here and right now. I don't care if I'm the only one that's going to tell you this. This was a shock to markets. This was a wake-up call. Kind of like when you're a kid, you don't want to go to school, or you're, just super tired, and you keep laying in bed and your parents are trying to wake you up, and then they tell you, hey, I'm going to throw some cold water on you. I'm going to get you up. And you don't believe them, and then they finally do it, right? This is that cold water moment for markets. And that is why the VIX was up so much like it was today. This was that first, oh crap, even to the most bullish investors out there, that maybe I'm wrong. Maybe a recession could be on the table. And for so long now, the consensus view, like the vast majority of consensus, has been soft landing, no recession. Fed's going to cut rates, and that's going to be good for stocks. And now we're seeing quite the opposite. You have seen today that JP Morgan and Citibank are both expecting a 50 basis point cut in September, a 50 basis point cut in November, and 25 basis points in December. That is 5 rate cuts throughout the rest of this year. That is not a normalization process of the Fed. That is not just bringing down the federal funds rate to not be as restrictive on the economy. That is cutting because of recession. That is cutting because of recession risks rising. Now, with that said, markets are not even close to pricing in a recession. Like, we're not even at the ballpark yet. I guess since I used the first inning analogy, perhaps we're in the first inning. We'll just stick with that. But there's a lot of areas that are not even to the ballpark yet. Like big tech for that matter, that are still trading at very much not recessionary kind of valuations. Now, there's a lot of panic and there's a lot of fear that goes into a potential recession. And a lot of the time, the fear or the panic can be worse than the actual recession or slowdown that does come. And you've got a little dose of that panic today. A little dose of that panic today. The Russell is off almost 10% from the highs that you were at on Wednesday. There's definitely some panic today. The S&P is still only down about 6.5% from all-time highs. So, I mean, even if this turned into a correction, you could potentially be only halfway through it, maybe less than halfway through it, if we end up falling, let's say, 15%. Now, I think in terms of the analogy that I gave just a few minutes ago, that water getting thrown on you, think about how you react the next time your parents go to wake you up and they tell you, I'm going to throw water on you. You get your ass up, right? That's kind of how you can think about the markets when it comes down to economic data now. The markets have their attention on the data. They are going to look for more signs of a recession. So at this point, bad data will be bad data. Bad data for the economy will be seen as bad news for markets. That whole, bad news is good news thing is dead. It's over with. And the problem is, especially with the unemployment rate that shocked investors today, is that tends to be a very lagging indicator. So really, I mean, today's unemployment rate is likely much higher than 4.3%. It could be 5%. We could be heading into a much larger, much larger kind of slowdown here, and it's creating a lot of uncertainty for markets. Now, you also seen today that Japanese stocks suffer their biggest fall since 2020 on economic concerns, down about 5.8%. And I mean, it's just one of those scenarios where things could get worse globally, not just here in the US. The US tends to lead what happens globally. So if markets start to sell off in Japan, their market has done very well. It looks like futures, at least, Japan could open down 5% on Monday, which is just egregious. Okay, perhaps you could say Japan imploded the financial world. There's some people like Zero Hedge that have been saying that, but if the selling gets even worse in foreign countries as well, foreign markets, that could kind of amplify some of our selling as well. Now, if you just think about how high markets are still, even after this 6% drop or so we've seen in the S&P, if you look at the highs that you've seen towards late 2021 for the S&P, you are still up almost 15% from those highs. I mean, there is still a lot of downside left in markets, even if we never get a recession. Even just as, recession odds start to rise. And I think over this weekend, you'll get a lot of digestion of that. And I think coming on Monday will be pretty important to see. But from today's prices down to the last time we were 100% pricing in a recession was back here, October of 2022. Bloomberg had reported a 100% chance of a recession over the next 12 months. That would be downside of almost 36.5% from here. Like, literally, when I say you're in the first inning, you are literally in the first inning. Now, markets don't tend to go down in a straight line. They normally don't tend to go up in a straight line either. I think the next couple of months are going to resemble 2022 in terms of volatility. Big rallies, bear market rallies, big falls. But I think you will trend lower. Now, I think the biggest question is, because there's a lot of guys on Wall Street coming out today saying this is a buy the dip opportunity. It is not a buy the dip opportunity. It is not. It's not. Okay, that's just my personal opinion. When the Fed historically cuts rates into a weakening economy, you on average get a 23% pullback in the S&P. Now, you've rallied a lot in the past, 12, 24 months. It could be even larger than that. It really just depends. But this whole narrative of the Fed cutting rates is good for stocks, it only applies if the Fed is cutting into a strong economy. If the Fed is cutting into an okay economy at that. It does not apply if the Fed is cutting into a weakening economy. If the Fed is cutting into a weakening economy, cutting is always seen as bad for stocks. And unfortunately, that's what this is starting to look like. Brian Dietrich writes on X, we've been saying for months that inflation was last year's problem and the Fed should start cutting. The big worry always was a potential policy mistake, and that could be happening. The Fed totally missed transitory, and now they missed the much better inflation. As I shared in the last video, Liz Young Thomas on X, she is the chief or the head of investment strategy at SoFi. She says the SOM rule recession indicator triggered in July. Fed Chair Powell said it's not an economic rule, but a statistical regularity. In any event, here we are. This has a foolproof track record of predicting recessions. And again, it's showing the volatility of unemployment. It's equally, if not harder, to get the unemployment market under control once it's too late than inflation under control. Meaning that, once that cat is out the bag for the labor market, for the economy, for unemployment, good luck trying to get things under control. And that's where we are now. You're in the early stages of an acceleration in the unemployment rate. And I would expect this is likely going to continue to accelerate into the end of this year. Now, I want you guys to take a listen to what JP Morgan just said following their call for a 50 basis point rate cut in September, 50 basis points in November, and 25 basis points in December.
JP Morgan Chief U.S. Economist Michael Feroli joins us now to discuss, wow, and that escalated quickly. Why are you going so bold with these double predictions for rate cuts?
Look, I think even if we have a moderation in these job numbers, if they improve, let's say in the next month's report, still feels like risks are pretty balanced on both the inflation and employment mandates. So I would say, rates at 5.5% is probably about 100 basis points at least above where you should be if you think you want to be back to neutral to address risks to either inflation and employment. So if you think you need to be at neutral, why drag your feet in getting back to something like 4 to 4.5%?
Because they just want to be sure, right? On the inflation, it's why they've been so hesitant to cut rates until now, especially with the flare-up earlier this year.
Yeah, and I would just add to that, we heard 2 days ago from Chair Powell, and he was abundantly clear that he was going to be sensitive to weakness in the employment numbers. And, we got some hints of that yesterday, and then we got a very big indication of that this morning. So given Powell's message, I don't see why they would, want to just take, little baby steps in getting back on sides.
Well, he was also very clear on Wednesday that they were not thinking about 50 basis points as a cut.
Well, he said they weren't considering it on Wednesday. On Wednesday, they didn't have today's data in hand. So, when the facts change, you got to change what you're thinking.
But put this data in the context of other data releases we've had lately. I know ISM manufacturing was weak, but overall, if you look at GDP, if you look at the job openings picture, there's still more than 8 million of them. I mean, things are cooling, no doubt about it, but not suggesting necessarily that we're heading into a harder landing or recession type environment, which might be the signal if they start doing 50 basis point cuts.
So, you're right that I think, GDP growth in the third quarter we still think is going to be in positive territory. That said, we are, as you point out, losing momentum. So even a 4.3 unemployment rate is not bad in the absolute, but it's up 0.5 of a percentage point over the past 4 months. So I think we also have to keep track of momentum here, and momentum is sliding. I don't think the Fed wants to get further behind the curve than it already is.
Michael, is there any suggestion that the delay, if it is in fact a delay, is about reaching consensus at the committee?
I think there's always some of that. But, I think Powell has shown this is kind of his committee. But I think there's going to be little trouble getting consensus now for action at the next meeting. I think that would have been hard going into the July meeting, even though in hindsight, of course, you think they should have cut then. But I think you need probably more convincing evidence, and I think we got that this morning.
Meantime, we're starting to have conversations this morning about Jackson Hole and the opportunity that it might give Powell to say, at least we can read the room. We are on the case.
Yeah, I think that's right. I think Powell will probably send a pretty strong message there that they're not, asleep at the wheel here, and that the message from 2 days ago that they're going to be sensitive to labor market weakness is something that I think he'll back up vociferously at Jackson Hole.
Would you characterize this morning's print as weak, or is it more about, as some have suggested today, about a wave of nice participation taking shape?
So there definitely was the best part of this report, was the increase in participation. However, you did have a pretty significant increase in job losers, accounting for most of that rise in unemployment. So, and I would also add to that the fact that the work week went down at the same time that wage growth is moderating. So it does look like labor demand overall does appear to be softening. And you had actually less than half of industries participate in the increase in employment last month. So it wasn't a very broad-based gain in job growth either, which can be a bit of a worrying signal about overall labor demand.
Do you think we're going to see a negative payrolls print this year?
Certainly wouldn't rule it out at this point, given the way the momentum is shifting here, and I think you see a little bit of hints of that in things like the continuing claims numbers yesterday. We're not forecasting negative payrolls, but I think at these new lower run rate we've been seeing lately. It's not hard to get there.
And basically, long story short, what JP Morgan had to say there is not going to be positive for stocks. Imagine the day where non-farms actually do come in negative. Hell, it could be next month. It could be the month after that. By September, we could be looking at negative payrolls. Yeah, that's where a lot more of those recession fears are really going to start to kick in. Now, on the Fed potentially doing an emergency rate cut, there's been a lot of rumors about this today. I don't think the Fed wants to do that. If the data continues to show a rapid deceleration in the labor market, initial jobless claims could start to kind of add to that as well. I do think there is a possibility of an emergency style rate cut before September, because we have 5-ish weeks before September 18th. That's a lot of time to be behind the curve, to be waiting. The Fed is clearly behind the curve. They know that now. If things just get worse from here, then it's a possibility that there is some kind of emergency cut. Now, I think an emergency cut would be a big one. You're not going to get an emergency cut of 25 basis points. If you did get an emergency cut, that's going to crash the markets. That's going to be the easiest 25% drop you've ever seen in your life. And I think it would be at least a 50 basis point, if not a 75 basis point rate cut. I don't think the Fed would come out and do anything small in some kind of emergency fashion. Maybe even a 1% rate cut. I think that at this point is not the base case scenario, but that's why we want to watch the data, because if it gets worse, initial jobless claims start to spike even more, and this was not just another one-off unemployment report, there is that possibility of an unexpected, Sunday rate cut from the Fed. But nonetheless, I do think in the near term, it's possible to see a bounce here, right? The fear and greed index is now in fear territory. It was an extreme fear territory. So you're definitely getting pretty fearful out there. And you can even see via the VIX. The VIX went vertical today. Okay. The VIX was up 50% at one point. Normally, when you get these kind of spikes in the VIX, you do tend to fall shortly thereafter. The VIX tends to spike and then fall, spike and fall, spike and fall. It doesn't tend to stay high for an extended period of time. Sometimes it can for like a week or two, but normally you do tend to see a fall. Now, a lot of the VIX spike that you have seen recently compared to like 2021 or 2022 is because you were at such a low place, because basically everyone was in calls and nobody was in puts. Now that sharply flipped over the last couple of days. That's why the spike is so dramatic today. And for anyone that does not know, the VIX monitors or measures the puts and calls on the S&P. So if you get a day where everyone's going out and buying puts like today, nobody's buying calls, then you get a massive spike in the VIX. Normally, that can be an indicator of a potential bounce that could be coming. And if you take a look at the S&P 500, it looks like today you found a lot of support around that 100-day moving average at about $528.05. You actually bounced at $528.60. It wouldn't surprise me for a period in time until we get new information, more clarity from the Fed, that we bounce really just between the 100-day and the 50-day moving average. That is a range between 543 on the upside and 528 on the downside. That can be a pretty big range. A lot of volatility can transpire during this range. That is a range of about 2.7%. And that's kind of what I'm expecting here. I really don't think at this point we're going to get a lot more downside. I do think a consolidation of the downside, a bounce and some volatility makes sense from here. But guys, if there is nothing you have ever listened to here on this channel before, nothing. If you have just in one ear, out the other, everything I've said, all of the going out on a limbs that I have made that have been correct, including the last one, calling for a 6% downside move in the Russell by this Friday. By the way, it's down 9% from the high on Wednesday. That was a huge trade for us. Thousands of percent winners on some of those IWM trades. If you guys want to come trade with us, check out that link down below in the description of this video. But if there's one thing you have never listened to, let it be this. Let this be the thing that you have listened to. For your family's sake, for your sake, for everyone you know's sake, you need to be accumulating as much cash as possible. Forget the day-to-day, what we're seeing in the markets. Today's down, Monday might be up, forget that. We are going lower, in my personal opinion. We are going substantially lower, in my personal opinion. We are likely going into recession, in my personal opinion. I think a recession really doesn't matter too much. It's the odds of a recession. The odds of a recession went from like 0% 2 days ago to 15%, maybe 10% today. We're not even close to, if we go back to 100% odds of a recession, like the downside we're going to see in markets is insane. I think there will be a massive buy the dip opportunity. When the Fed starts to cut rates, they're going to cut rates a lot. It won't surprise me if they're cutting 1 percentage point, for some meetings when we do go into that actual recession or pretty close to it. The markets will panic. There will be a panic, and there will be a glorious buy the dip opportunity. And then we will wake up and realize there's cheap money again. The Fed's money printer is on, and this economy can start to stabilize and rebound. But I think there is a long way between now and then. I think stabilization, a rebound, is some point in 2025. From now until the end of this year, it is recession fears. And I think you will stair step up, but it will not be in a linear line down or linear line up for that matter for the markets. It's going to be volatile. And I think right now the problem with hedges after markets have had a day like today is they're going to be very expensive, and you're going to get this volatility. And markets are, I don't think, going to do too much until we get more big data. And the next big data we get is CPI, although I don't think that's as important now. Obviously, if it comes in, really high, that's bad. But if it comes in good, I mean, does that matter? Fed's already looking at cutting rates 50 basis points according to JP Morgan and Citi. And there's an 80% chance of a 50 basis point cut in September, as is from what the markets are pricing in. So it's really all about the economy at this point. And economic data moves very slow. So I don't think the markets are going to get too over the skis in actually pricing in a recession before it becomes a little bit more clear that's actually the direction that we are headed in. So I think cash is king right now. I think you want to be saving as much cash as possible. Get ready for that downside trade. I don't think the large downside trade, the potential 20, 30% downside trade, is coming next week or the next week after that. So I do think you have a little bit of time at least here. Before that big trade is here. And if you guys subscribe to the channel, if you're a part of the trading community, if you guys watch these videos each and every single day, trust me, I will not let you miss out. Trust me, I will not let you miss out. Now, that's not financial advice. I miss out on plenty of things. I make good and bad trades all the time. I tend to be very early to things. Okay. And I think with this large extended downside, I think I'm just early again, right? I think when everyone's going to tell you this is a buy the dip opportunity, no, it's not. No, it's not. I'm just early. So I'm just seeing things potentially months ahead before anyone else. And again, if you're not a trader, that's great. This is a better market for you because you're going to be able to just save your cash and get ready to buy the dip. Recessions have created more millionaires than lottery winners times 10x, 20, 30, 40, 50x over again. But you have to have money to make money in a recession. You have to be able to seize that opportunity. And if you now have, I've been saying this same thing for the last, 3 months, but I think you have more time to save as much money as possible, get out of debt, get ready to go shopping. I think housing will go on sale as well. If you want to get into rentals, I own a couple rentals myself. I think you're going to have a better chance to do that. Rates are going to fall. Home prices are going to fall at the same time. At that moment, that's going to be a fantastic time to lock in low rates as prices do fall on homes. Because yes, some people think that when, the Fed cuts rates, home prices go up automatically. No, in fact, when the Fed cuts rates, like back in 2019, homes actually fell 10%. right? When you get those initial cuts, home prices actually tend to fall. And then they tend to recover over the next, coming 6 to 12 months. But I think there's a lot of opportunities basically everywhere. You just got to have money to be able to take advantage of that. And I think Tesla, for an example, is going to go a lot lower, right? It's going to go a lot lower. Do I think it's going under 140? Probably not. So if you bought any shares around there, I think you're good. But back to the 170s, even 160s over the next 6 to 12 months is a possibility. Now, there's robotaxi events, there's other things that are going on, but I do think when the panic comes, it's going to hit everything. It's going to be like the Rona panic, but panic over a recession. So let me know what you think about all of this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day, and I will see you in the next one.